Hello guys, this is your boy is back here and welcome to another interesting episode. Guys, in today's video we are going to talk about risk management 2.0 elite, all right, for the intermediary traders and even for the beginner traders as well. I'm not going to talk about professional traders because if you're professional, presumably we assume that you know what you're doing. You understand me? So this is for the intermediaries and for the beginner traders, all right? If you've not watched my video called Risk Management 1.1, guys, make sure you go on my channel and watch that video, all right? Or we will put it here so that you can watch it, all right? So, guys, this is Risk Management 2.0 Elite. Guys, this is very, very important. What I'm going to share with you, two fundamental, most crucial risk management secrets that helps a lot of great traders to succeed in the trading industry. All right, so guys, you may want to stick with me till the very end, okay? And trust me, by the end of the video you will get a lot of value, all right? Strategic and practical knowledge that you can apply in your trading career to make sure that you keep your risk on check and on point. All right, guys, having said that, I go by the names back and let's not waste time anymore. Okay, let's go. So guys, in today's video I will show you two most important risk management factors. All right, I've talked about the other ones in the risk management 1.0. all right, so you should watch that one before coming to watch this one, okay, so that you understand the basic level of risk management for a newbie. Then you come and add this one to it, all right, just to buttress up your whole knowledge about risk management. Okay, so the two things we are going to talk about is risk to reward. Guys, you hear many traders talk about risk to reward, but they never show you how it is. All right, now after I finish doing my presentation, allow me to do my presentation. When I finish, I will take you to the desktop and I will show you the concept of risk to reward, okay, practically how it is. Okay, and after that we will talk about another important thing, which is the percentage that you should risk on your trading capital. Okay, to have this proper understanding of the percentage to lose in your trading capital will help you on the long run. Okay, now guys, I'll give you a bonus point. All right, very, very important. I'll give you a bonus point that has to do with the psychological part of risk management trading. Okay, so stick with me, you don't want to miss that one. Okay, so let's get on the chart. Okay, so here we are on my chart. All right, so we're talking about risk to reward. Okay, so many people think that I just have to make money and that is all. No, it's not just making money and that is all. You see, trading without risk management is like gambling. Okay, it's like going to the casino. It's like gambling. What makes trading trusting and calculative and profitable is because there is a robust amount of risk management knowledge backing what traders do. Okay, so we're going to talk about risk to reward. Okay, now whenever time you're trading, you want to have a risk to reward. Now we won't talk about the scalpers, all right, and the high frequency traders, because they have a different way of risk to reward approach. Okay, you have a different way of risk to reward approach, which we are not going to jump into it in this video. Right, what we're going to look at is from anyone who does intraday trading. Okay, so their risk to reward, okay, how they should keep their risk to reward check. Okay, now let me explain first of all what is risk to reward. The idea of risk to reward is that how much are you risking of your capital to get in return a reward. Okay, so in trading you use money to get money. Okay, but you can use a little amount of money to get that same amount of money back or even more. Okay, I hope this explanation here was quite good. Now this is what we mean by risk to reward. Okay, so if it was quite good, guys, click the like button. Okay, so you are risking something for something. Okay, and based on your setup, based on your trading knowledge, based on your trading strategy, you can risk a certain amount of money and get that same amount of money back, or get even more than what you are risking. All right, so if we look here right now, okay, I think stick with me. All right, I want to show you something. All right now, okay, 1 2 3. Okay, so this looks like the strategy that I taught you guys on the trend strategy. Okay, so if you've not watched that strategy, you can go and watch it. All right, now it is playing out, but I don't like this bullish here. Okay, I don't like this bullish here. It's too big, so I would have waited for the market to come here, retest on this zone, but it didn't give us a candlestick pattern. All right, so we don't jump in. But let's assume if we entered into the market here. All right, let's assume we entered into the market here. All right, good. So if we entered into the market here, guys, normally the idea is you want to risk 1 and get either 1 or 2 or 3 max in return. Okay, you can even go for more, 4 5, but it's better to stick with 3. When you start to go beyond 4 5 6, that means you're trying to be greedy. All right, not to say that certain setups don't come for that, but you want to play it cool. All right, so normally you want to go for a risk to reward 1:1. So that means if you are risking, let's say $1, you will get in return. If you win, you will get in return $1. All right, if you are risking, let's say $5, and you're going for a risk to reward ratio of 1:1, then you get $5 back. Okay, because you are risking $5 and you are going to get $5 back. Okay, now if you're going for a risk to reward 1:2, then that means if you are risking 5, you will be getting 10 back, not 5, because you are risking 1 for 2. Okay, so, and the same thing for 3. All right, so if you are risking 1 for 3, then that means you'll be risking $5 and you'll be getting in return $15. All right, so you multiply that by, you do that with the same amount of money that you want to risk. Okay, so what you want to risk times 1 or times 2 or times 3. All right, good. So let's say we are here, right, and we want to risk 5, let's say 10 pips. Okay, if we want to risk 10 pips, this is where, do you see where the point is? Good. Now this is 10 pips. Okay, so that means our stop loss will be here. Okay, our stop loss will be here, and our take profit, if we are going for risk to reward 1:1, then our take profit will be on 10 pips. Okay, if we are going for risk to reward 1:2, then it will be on 20 pips. Okay, if we are going for a risk to reward 1:3, then it will be on 30 pips. All right, good. So the science behind here, behind risk to reward, and I love it. I love this idea behind, this concept behind risk reward, which is the idea of the rewards is for you to get more profit and save your losses, your future loss. Okay, the losses that you will be incurring in the future, you want to get more rewards so that it will cover the future losses. Are you getting it? Because in trading, losing is inevitable. All right. So that is why we want to go for a good amount of reward, a minimum. If your strategy is not good, it should be able to give you a minimum of 1:1 as a risk to reward. All right. But if it is below 1:1, then you might be applying a different type of strategy. Okay. But which that one we will not go there for today. Okay. So risk to reward 1:1 is the minimum. Okay. Then a risk to reward 1:2. So if you go for a risk to reward 1:1, that means, and if you win, that means you went into the market with 1 and you got an additional 1 added to your 1. So the next time you'll be going into the market, you won't use your own money. You'll be using the money, the 1 that you got in the market. So if you got 5 euros or $5 in the market, the next time you will be going to trade, you go with that $5, which is not your money, but it's the money that the market gave you. Are you getting me? So if you lose that $5, you didn't lose your money. You lost the money that the market gave you. All right. So imagine the scenario whereby you went into the market with a risk to reward. You were risking 5 and you were going for a reward of 2. Okay. So 10 in return. And let's assume you got it. Okay. You made that profit. Okay. So you got 10 in return as a reward. Okay. So the next time that you will be going to trade again, you are not going with your own $5, but you're going with the $5 that the market gave you. The $10, you're going with the 5 out of the $10 that the market gave you. Okay. So you go with 5, and when you lose, you didn't lose your money. You lost what the market gave you. Okay. So you've lost 1/5 out of the 10. So the remaining is 5 left. $5 left. All right, guys, if it is clear, let me know in the comment section that clear. All right. So you have $5 left. All right. That is what we are talking about. That is what I told you about, you saving your future. Okay. That is the power of risk to reward. Okay. I will show you more tricks about risk to reward. And this like the moment I understood this, it was like a revelation to me. Now, that 5 that you have left right now, if you go into the market right now and you lose that 5, now you've lost the 10 that the market gave you. Now you are back to square zero. Okay. But guess what? If you go with that 5 again, with a risk to reward 1:2, and that 5 wins, okay, that trade wins, and you make money and you get another 10 back, guys, guess what? You've recovered the old lost. You have your 5 that the market gave you, that you presented to the market, you have it back, and now you've recovered the 5 that you lost previously, and you've gained another 5 back. I don't know if this, I don't know if it is clear, or if I'm confusing you guys. I don't think I'm confusing you guys. So guys, let me know in the comment section. All right. So that is why it's important that this risk to reward factor here, guys, you can never underestimate it, because if you have a very good risk to reward, you may lose twice, 2 consecutive trades. Okay. But if you have a risk to reward 1:2, you can recover that losing trade. Okay. So let's say you went into the market with $5 and you were going for a reward of 1:2, okay, which is $10. You went in the first trade, lost. You lost $5. You went into the second trade, boom, you lost again. So how much money have you lost? $10. Okay. Now, the $10 that you've lost, guys, if you go into the market again with another $5, and guys, you make the money back with a risk to reward 1:2, guys, you will make $10 back. Guess what? In one trade, you've recovered the 2 trades that you took that you lost your money in. You recovered it with just 1 trade. Are you seeing the power of risk to reward? Imagine if your risk to reward was 1:3, okay, and you lost the first $5, you lost the second $5, and you went in with another $5. Guess what? You would, and if you won, you would have recovered your own $10 that you lost, plus that you will make an extra $5, which in the next trade you won't use your own money, but you will go with that $5. Look at the advantage that risk to reward gives you. Now, if you go with that $5 again, okay, and you are playing a risk to reward 1:3, guys, guess what? Now, if you go in and you make that profit with that $5 and you win a reward of 3, guys, you are now at $15. You are now sitting at $15 plus the previous 5 that you won. Okay, so you are now at $20. Now, how many 5s do you have? You have 4 5s. Who gave you this 4 5? The market gave you this 4 5. So to lose these 4 5s, it will take 4 consecutive trades to lose them. Are you getting the power of risk to reward? So that is why every time you see many traders, like they draw something like this, they get the rectangle and they will draw something like this. I'm not on MetaTrader. I'm not on Trading View right now. You see that they draw something like this, okay? And they draw something up here like this. Okay, good. Properties. Let me change the down one. Okay. And normally here, that's why when it comes to this thing, Trading View is cool, all right? MetaTrader is still mechanical, guys. So this means that they are risking this, okay? They are risking, let's bring it down to, let's say, 10 pips more or less, okay? So this means they are risking 10 pips, okay, more or less. Good, 10 pips. You can read it on the left side, on the right side, sorry. And they are going for 30 pips, okay, 30 pips. Here we are. So you see, a risk to reward of 1:3. Are you getting it? Now, this reflects my strategy, all right? The strategy that I placed on my channel, which is a naked market trading strategy that follows the trend, all right? It looks similar to this thing. So guys, if you've not watched that video, make sure you go and watch that video, all right? It contains a lot. So this is the concept of risk to reward. Every time that you are trading, all right, guys, go for a risk to reward that fits your trading strategy, all right? Go for risk to reward that fits your trading strategy. How do you know the risk to reward that fits your trading? That fits, not fix. That fits your trading strategy. You will know it by back testing it. You understand me? Certain strategies are very good with a risk to reward 1:1. Certain strategies are good with a risk to reward 1:2. Certain strategies are good with a risk to reward 1:3. And that is my strategy that I placed on my channel, okay, about the trend trading strategy, okay? So you can go and watch that strategy. It will help you a lot, all right? So guys, let's keep moving, all right? Let's go to the second risk management factor, okay? Guys, the second risk management factor that is very, very important is that in trading, guys, you must always lose 1%, at max 2%, not more. This is the standard, all right? Why do we say that risk 1% or 2%? So that, you know, it will take you more time for you to lose all your capital. Are you getting me? You won't lose all your capital in a one strike. Okay, so let's say if you have a capital of $100, okay. Now I'm dealing with newbies, okay. I'm dealing with newbies, so that's why I want to break it down. I want to break the numbers down and not overcomplicate things, okay. You have $100 and you are risking 1%, not 10%. All right, y'all guys need to take your 10% to church. All right, not in trading. So you have $100 and you're risking 1%. 1% of $10 is $1. Okay, so if it is $1, now ask yourself the question: how many dollars do I have to lose before I lose all my $100? Italian man will say, comprende? You have to lose 100 times before you lose all your capital. That is why we say that it is good for you to lose 1% of your capital, at max 2%. All right. So if you have a capital of 3,000, what is your 1%? Your 1% is $30. Okay. If you have a capital of $10,000, what is your 1%? Your 1% is not $1,000, but it is $100. All right. If you have a capital of $20, what is your 10%? Your 10% is not $2, but it is 20 penny or cents. Okay, are you getting me? 20 cents. So, guys, putting these two things together here will help you on the long run. Risk to reward and the amount of money you risk on your capital. It is very, very important. And guys, here is the magical portion to this too here. Guys, you need to do this repeatedly. This is where the magic happens. You need to do this repeatedly. Every time risk 1:3 or 1:2. Every time, keep on doing that. Keep a risk to reward ratio of 1:2 or 1:3. Every time, keep it like that. Keep it like that. Keep it like that. And keep on risking the 1% per every trade. Okay? So you remember the example that I gave you about you risking $5, right? $5 is the 1% of $500. So if you have $500, your 1% is $5. So if you have $500, you are not supposed to be risking $50. That is how many people go broke. That's how many people get their accounts liquidated. Are you guys getting me? So you don't want to fall into that trap, okay? So guys, it's very, very important that you practice this thing. Practice this thing on a demo account till it gets into your cycle. Well, since we did talk about cycle, well, let me bring it in. The bonus, guys, then we end the video, all right? The bonus tip for you guys is, guys, you need to risk what you can afford to lose. Now, I've given you the foundations. Never go with a risk to reward 1:1 minimum. If your trading style or strategy can't guarantee you a risk to reward 1:1, you better look for another one. All right. So your trading strategy must guarantee your risk to reward 1:1. 2, you should risk 1% of your capital, a max of 2%. If you're a newbie, I recommend you stick with 1% and not more. That is why we're saying that in trading, you need more money. You need more capital. Do you understand me? Because you have a $500 and your $500 is very, very big, but your risk to reward has to be 1%. So that would be $3. Sorry, just say $500, right? So it will be $5. Are you getting me? So you'll be you have this big capital, but yet you are using a very little portion of it to trade. Are you getting me? And so it doesn't give you more return. So in trading, we think in percentage wise. That is why you need big capital. And when you have big capital and you are in that percentage thinking mood, then you got it done. All right. So having spoken about these two, guys, now we talk about the part which is risk what you can afford. Okay. Now for the newbies, guys, if we say risk 1%, all right, and psychologically speaking, you are not at peace with it because it's too much of a money for you based on the capital that you have. Okay, so let's say you have $10,000, okay, and you are risking 1%, and that 1% happens to be $100, okay, and the moment you press buy or sell, $100 is too much for you. You are scared of that $100 that you are putting on the front line. My brother, drop low, risk 0.50%, risk 0.70%, risk 0.25%. You are not in a race with anybody. You are not competing with anybody. You are not competing with anybody in this trading journey. All right. So do what suits you personally, respecting the right risk management rules. All right. Don't compare yourself with another one, because in this trading industry, we all have different risk appetite. Now, I told you that, guys, you should risk 1%, at max 2%. This is the standard. But guess what? There are those who risk 3%, 4% sometimes, because they can allow themselves to do that, because they know what they're doing, because they know the capital that they have, because maybe they trust their strategy, because they know that setup that they've seen. They know that is going to certainly play out. And these moments happen in the in our trading career. You understand me? But as a newbie, my brother, don't rush yourself. Stick with these rules that I've given you. And guess what? Over the time, with time, you become great, and you will see yourself compounding your trading, and you will see that you will be able to compound your trading accounts over the time. This is what makes trading masters. Thank you very much for your time. And this is the whole secret behind the success of trading. You understand me? When you get a good strategy, you need a very good risk to reward plan to attach to it. All right. So guys, watch risk to reward 1.0. Add this one to it. Make sure you understand this one, because this one is the core. All right. Then after that, guys, you are ready to go. The rest is practice, practice, practice. I go by the names back, and I approve this message too as well. Guys, guess what? I'm gonna see you in the next video. Peace.